How trading works. Buying, selling financial instruments via a broker. We buy and sell these futures via a broker, which is not that person in a suit and tie with a briefcase telling you where to invest. So, there is us, the broker, and the rest of the market. We send the order to the broker, who, usually, sends it to the market. The broker is, therefore, the intermediary who takes commissions. This applies to all contracts, especially CFDs, where he also takes a spread. Order IO broker market profit, loss. Order returns commissions plus spreads. 21. The spread is nothing more than the difference between the real market and the entry price offered by the broker. The two extremes of the spread are the bid and ask. On the other hand, commissions are a three-variable cost, depending on how much you buy or sell. If, for example, we have a commission of €10 per contract, it means that for each contract traded, we will have to pay €10 to the broker. The broker makes you buy here, I want to buy here. The broker, in return, will grant us leverage. Basically, the broker provides you with margin, as if he were lending it to you. He doesn't physically lend it to you, but he provides you with his margin so that you can buy or sell more contracts than you actually have money. For example, if we put €500 on a broker with a leverage of 1 to 30, we will have 30 times more firepower than our capital, giving us purchasing power of €15,000 instead of €500. 22. Me broker 130, €500, €15, your deposit, your buying power, sounds good, but can you see how risky it is? Because the moment you use all this buying power to buy or sell, it means that you buy or sell more than you can afford and, therefore, risk more at the same time. So yes, leverage can make you more profit, but it can make you lose money much faster and burn your account much more quickly. So leverage is only good when correlated with manic risk management. 23. I buy and then sell to take profit. Sell, buy. I sell something I don't have and buy it at a lower price, ideally, buy. How buying and selling works. Trading works like this. If we expect the price to go up, we buy, long, and sell when the price goes higher. Or, if I expect the price to go down, we sell something we don't actually own. In practice, if you are usually used to selling what you own, shorting is selling something you don't own, and then buying it back at a lower price and cashing the difference. So whether the price goes up or down, we will still try to take a slice of its price movement to profit from it. To buy and sell, we can do it in two ways, either at market, by clicking the Buy or Sell button, or we can do it with pending orders. On the market, I enter directly on the level a pendant. I am waiting for the price to come back to execute the order. 24. Sell limit, buy limit. Order types, stop and limit orders. Pending orders are orders in which you set a price level other than the level you are currently at, and you tell the broker that you will only buy or sell if the price reaches the level you set. There are two types, limit and stop. Buy limit orders. Used to set a buy at a price level lower than the current price, the order will only be triggered if the price falls to the level we set, ideal for trend-following strategies. E.g., the price is going up, and we hope it will fall so we can buy at a lower, cheaper, discounted price. Sell limit orders. They are the exact opposite, i.e., if the price is falling and we want to sell from a higher, premium, level, we can set an order that is only triggered if the price rises to that level. 25. Stop orders work a little differently. They work when a level is broken. Buy stop entry. Buy stop. The price is rising, and we want to buy at a higher level than where it is now. Sell stop entry. Sell stop. The price is falling, and we want to sell at a lower level than where it is now. 26. In any case, if we buy, the price goes up and then sell, we have gained. If, on the other hand, we buy and the price instead of going up goes down, we will be at a loss if we liquidate the position by selling. So what happens if the price drops indefinitely? We could potentially lose all our money. Since no one wants this, a stop loss is usually inserted into every order. Stop loss and take profit. The stop loss is an order that stops the loss in case the price does not go in the direction you were hoping for, in which case you have to set a price level where the order will automatically close. Lower for buy trades, where you sell at less what you paid more, and higher for sell trades, where you buy at more. In the same way but in reverse, we can place an order called take profit, where if the price comes in, the trade will automatically take home the profit. Take profit entry. Stop loss entry. 27. Risk-return ratio. We realize that there are entry orders, which can be buy or sell, limit or stop, and then there are exit orders, such as take profit and stop loss. Going into risk versus return, the stop loss corresponds to our risk, while the take profit corresponds to the potential return. In each position trade you will enter an entry level, a stop loss level and a take profit level. If the price should reach from the entry level the take profit, we will win. If it should reach the stop loss we will lose. Take profit, entry, stop loss. 28. The ratio between the take profit and the stop loss, i.e., between return and risk, is called the risk-return ratio. Let's take an example. If I risk €1 to take €1, my risk-return ratio will be 1 to 1. If, on the other hand, the take profit will be a bit larger, i.e. we always risk €1 to gain 2, the risk-return ratio will be 1 to 2. Thus, the risk-return ratio is the first key element of our edge, or statistical advantage. Risk-reward €1 profit €1 risk. Risk-reward €2 profit €1 risk. 29. Win rate. The second key element for our statistical advantage is the so-called win rate, which is expressed as a percentage. To explain it simply, if out of 10 transactions we win 5, then we have a 50% win rate. If out of 10 we win only 4, I will have a 40% win rate. If we win 7, we will obviously have a 70% win rate. Win rate and risk reward are the elements we need to understand whether our strategy is profitable. Basically, if we have a win rate of 50% and a risk-return ratio of 1 to 1, it means that the result will be 0, because for every take profit we take a stop loss of the same value. Therefore, such a strategy is not particularly profitable. EURCHF, BUY 1% USD CAD, buy plus 1% EURUSD, sell 1% plus 0% GBP/AUD, buy plus 1% 1%. 30. However, if at the same win rate, i.e. 50%, we have a risk-return ratio of 1 to 2, it means that for every stop loss of €1, we have a take profit of 2. So with only 4 trades I totaled losses of €2, but I totaled winnings of plus €4, so I gained €2. EUR CAD, BUY 1% GBP USD, sell plus 2% NZD USD, sell 1% plus 2% 0% GBP JPY, buy plus 2% 2%. Therefore, we must try to build a strategy with a win rate and risk-return ratio that allows us to make profits. 2.6 Risk Profile. Another important aspect is to understand which risk profile to use. We cannot risk all our capital in every transaction, so we need to understand how to manage risk and what percentage of capital we want to risk. It can be a very low risk, for example 0.25%. It can be 1%, it can be up to 5%, which is very high. 31. Or you can risk as much as 10%. Of course, this is sheer madness. But in reality, the risk depends on the type of strategy you use. So if you have a strategy that has a 100% win rate, which, alas, does not exist, you can also risk 100% of your capital, but unfortunately it doesn't work that way. Always try to have a statistical advantage over the market because you are not the only one who wants to make money and profit from trading. Plenty of banks, institutions, investment funds and professional traders from all over the world are trying to make money from the markets. If you have just arrived, you count for nothing in the market. As much as you may think that the competition is only with yourself, since you are there alone against the graph, in reality the market is very competitive. In order to be profitable, one must first develop a functioning strategy and then start with the right foundation. I hope you liked this video. Kindly like, share, subscribe to this channel for more amazing videos.